liquidity providers expect it's going to force physical prices over $500 per ounce higher. By the end of the first quarter of 2025, it's going to force silver to break out into all-time highs. And this is not guesswork. It is simply a matter of looking at the supply-demand fundamentals and the inability to settle it in the paper markets.
China's strategic push to strengthen its gold reserves is a crucial driver behind the gold market's dynamics. The People's Bank of China, PBOC, has been actively working to attract undervalued Western gold, positioning it as a safeguard against potential financial and military challenges. As part of this strategy, China has adjusted the Shanghai Gold Exchange, enabling smaller firms to participate. This move will push gold prices by more than $500 per ounce by the first quarter 2025. Furthermore, China's actions are closely tied to its broader agenda of supporting the yuan and advancing the BRICS nations' de-dollarization efforts. According to Andrew Maguire, this initiative is highly significant. Liquidity providers anticipate it will drive physical gold prices up by $500 per ounce, with silver potentially reaching all-time highs by the end of Q1 2025. Maguire emphasizes the rising tension between leveraged paper markets and the growing dominance of central bank-backed gold purchases as he analyzes last week's gold retracement rally. China's economic and strategic policies have far-reaching effects, particularly in the precious metals market. The People's Bank of China, PBOC, has been converting substantial dollar reserves into gold as part of a broader strategy to hedge against potential geopolitical shifts. If China, in collaboration with Russia, were to transition toward a gold-backed currency, it could trigger a global revaluation of central bank gold reserves. This shift would reshape the gold market and have profound implications for the worldwide economy. Maguire believes we're witnessing a potentially significant escalation, with growing tariffs and a very fragile situation over Taiwan, coupled with numerous threats. He also points out that the U.S. is openly preparing for war with both China and Russia. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
The strategically timed launch of the Shanghai Futures Exchange blindsided traders betting against gold. The stealthy BRICS-related initiative to attract more Western-priced gold and silver into China, and I say silver too, by no coincidence confluences with the anticipated options-related paper gold sell-off. We just looked at it on the charts. Now, the PBOC relaxed Shanghai Gold Exchange rules to allow smaller firms to trade smaller volumes on the SGE physical exchange. Now, this is, I cannot understress how big an initiative this is. It's completely unfactored into current supply-demand assessments. In fact, liquidity providers expect it's going to force physical prices over $500 per ounce higher. By the end of the first quarter of 2025, it's going to force silver to break out into all-time highs. And this is not guesswork. It is simply a matter of looking at the supply-demand fundamentals and the inability to settle it in the paper markets. Now, to give an idea of scale, there are 55 million, this is not typos, 55 million small and medium-sized enterprises, what they call the SMEs, this is really designed to capture. And they contribute, to give that idea of scale, 50% of all the tax revenue. They produce 60% of all the GDP. They're 70% of technological innovation, and actually a massive 80% of urban employment. Now, these firms are turning, just to give you an idea of scale, on the kind of scale this is. And in fact, the March 2024 published data indicates the number of newly registered enterprises in China reached an average of 23,800 per day. That's not a typo again. This is massive. Now, the scale of this starts to filter in. Now, while the Shanghai Futures Exchange launch was viewed as speculative and everyone was saying, oh, this is just speculative, and it was wrongly interpreted as fickle. And as we've been tracking the PBOC, this is stealthy. This is by design. The PBOC deliberately stands behind each incentivized gold buying initiative, underpinning it long enough for the global physical price to actually catch up and anchor a higher central bank buy point and institutional central bank buy point, thereby strategically bolstering their massive state-held, official, and as yet unpublished monetary reserves, gold reserves.
Gold and silver prices have been far from stable, impacted by geopolitical uncertainties, evolving economic trends, and fluctuating market sentiment. With the dollar strengthening, the euro weakening, and central banks increasing demand, investors are left grappling for clarity in an unpredictable landscape. Maguire explains that we're witnessing Western-facing actors square up unbacked futures bets made up to 12 months ago, with positions crystallizing at first notice in December. At this point, all the unbacked fiat gold, representing 96% of the contracts, must be fully funded if it hasn't been rolled over into another contract or exited the system. Now, let's redirect our attention to a video.
An ongoing wholesale market assessment of where the inflection point is into where an increasingly illiquid Western-facing paper gold and silver market pitches up against the increasingly liquid global South-facing physical markets. Now, we've simply been tracking this we've been tracking by stealth gold price revaluation process, which is evident by the series of higher central banks underpinned physical stairsteps is really revealing the Fed's weakening gold price suppression hand. Now, we're going to revisit these central bank supported stairsteps shortly, but to answer our subscribers' immediate questions, let's look at what to expect. Now, well, here we are again, just exiting the last options gaming of the year. And remember, options gaming is where a massive amount of derivative bets that are basically only underpinned by 4% of value of what they're controlling, or even less in options. What's happening is we're just exiting this last gaming of the year, which is the December contract, which expired on Monday. So now this is the single largest delivery month. I say delivery for COMEX because delivery is not always delivery. It's a paper settle market generally, or it shuffles warrants between really this siloed world. But some of the stuff escapes out the back door, which is kind of what we're looking at. So what we're doing is we're witnessing the Western-facing actors squaring unbacked futures bets against that were made over 12 months ago, up to 12 months ago, being crystallized on Monday and into first notice, which means that everything, all this 96% stuff that basically unbacked fiat gold has to be, if it's going to stay, if it hasn't rolled over to another contract, if it hasn't exited and squared, it has to be fully funded. So therefore, when first notice comes, it requires fully funding them. So really the speculators disappear, and it really shows you where the physical market positions are. Now, we're also going to witness bets that being made 12 months further out into December 2025 as well. So actually, when we assess these wholesale to paper market footprints, this is not actually rocket science. It is simply the inflection point where enough 96% leverage, naked short, momentum-driven COMEX supply, whether it's long or short, has overrun the next rising layer of central bank, sovereign, and institutional physical buy levels. Now, so with that in mind, let's pop in to look at the charts, to look at the footprints, and really to put this last 2 weeks' action into context. And as you say, Shane, we'd identified an almost exact inflection point setup that looked like the momentum-driven May lows. And now we see another one playing out into this Thanksgiving thinned month-end action.
The ongoing changes in the gold and silver market signal a broader shift from paper-based markets to a more physical, central bank-backed environment. China's strategic actions are playing a central role in this transformation, positioning the country to take the lead in the precious metals market. For investors, the coming months could be crucial as demand for physical gold and silver rises and global central bank policies reshape market dynamics. The gold market is entering a new phase, where China, central banks, and physical demand will likely drive the narrative. As volatility continues, staying informed and understanding these developments will be essential for anyone looking to navigate the precious metals market successfully. With the shift from paper-based markets to physical, central bank-backed gold, what changes do you foresee in the precious metals market? Don't forget to subscribe and click the bell icon to stay informed about our latest updates.